All right, let's dive right into this explainer. Today, we're going to pop the hood on Truist's Q2 2026 earnings report and see exactly what is driving their seriously impressive financial engine right now. Whether you're deeply embedded in the financial sector or just keeping a close eye on major market movers, there is a lot to unpack here. Truist just released a quarter that genuinely demands our attention, and it's full of strategic maneuvering and some really solid numbers.
To inspect this engine, here is our game plan. First, the Q2 earnings headline. Second, revenue and expense drivers. Third, loans, deposits, and margin. Fourth, credit quality and risk. And finally, number 5, capital returns and leadership.
Let's kick things off with Section 1, the Q2 earnings headline, or as we like to call it, the speedometer.
The absolute standout headline here, a massive 37% jump in earnings per share compared to the second quarter of 2025. That brings them to $1.23 per diluted share. And right alongside that, they pulled in $1.5 billion in net income available to common shareholders. Look, when you see a 37% jump in EPS for a bank of this size, you know the engine isn't just running, it's accelerating. Honestly, in the banking world, a jump that big is like finding a turbocharger in a golf cart.
Anchoring these top-line results is a total revenue bump of 5.5% on a taxable equivalent basis compared to this exact same time last year. And this wasn't just a fluke, it's a broad-based lift. They're seeing higher investment banking, trading, and wealth management income flowing right into these top-line results.
Hearing directly from leadership, CEO Bill Rogers attributes this direct success to disciplined execution and higher fee income, which really sets a confident tone for the rest of our inspection. He specifically noted the deepening of client relationships and real improvements in operating efficiency. You know, it's one thing to have a good quarter because of lucky market tailwinds, but it is an entirely different beast to actually engineer it through disciplined strategy.
Moving right along to Section 2, Revenue and Expense Drivers. Let's look under the hood.
Diving into the breakdown, total non-interest income hit $1.64 billion for the quarter. We're specifically noting the upward trends in wealth management and equity investments here. Wealth management alone pulled in $375 million. That is up 7.8% from last year, mostly due to higher assets under management. What this shows us is that their fee-generating services, the parts of the bank that don't rely strictly on interest rates, are performing remarkably well.
And this next point brilliantly illustrates the balancing act of corporate finance. They saw a $91 million bump in non-interest income over the prior quarter, which easily outpaced their $72 million bump in non-interest expenses. So, why did expenses go up? Well, they're funding talent through higher variable incentives and making critical investments in their technology infrastructure. For anyone tracking financial health, this is literally the golden rule in action. Revenue growth safely outpacing the strategic expenses required to generate it.
Now for Section 3, Loans, Deposits, and Margin, the fuel and oil.
Just to make sure we're all on the same page before looking at the metrics, let's quickly clarify net interest margin, or NIM. This is essentially the core profitability metric of a bank's lending activities. It basically tells us how effectively the bank is acting as a middleman between depositors who want to return on their cash and borrowers who need capital. In today's really dynamic rate environment, monitoring NIM is absolutely essential.
So the crucial point here is that while their NIM compressed slightly by 4 basis points down to 2.98% due to higher funding costs, which, let's face it, is a reality in our current economic climate for almost all banks, they still successfully grew average deposits by almost $6 billion. That deposit growth was driven largely by interest checking, and at the exact same time, they successfully deployed that capital, growing average loans by $2.1 billion. In other words, they are bringing more fuel into the tank and effectively pumping it straight into the engine.
That loan growth? It was heavily supported by commercial and industrial expansion, with commercial loans hitting over $201 billion on average for the quarter. Why does this matter to you? Well, because when a major bank confidently grows its commercial lending, it signals a deep optimism in the broader business economy.
On to Section 4, Credit Quality and Risk. We need to make sure we have a clean engine. To figure this out, we monitor net charge-offs, or NCOs. This simply measures the actual loans a bank has finally given up on collecting. It's the cost of doing business and lending, for sure, but keeping this number low is the absolute hallmark of disciplined risk management.
In a really great sign of health, their NCO ratio actually dropped 11 basis points to just 0.5%. Because fewer loans are going bad, this allowed Truist to lower their provision for credit losses down to $395 million. Guys, that's an $84 million drop from the first quarter alone. Now, non-performing loans, which are loans that are late but haven't yet been written off, did tick up just slightly 0.51%, but context is key here.
While some specific loan segments, like indirect auto, required a bit of attention due to non-accrual criteria enhancements, the overarching story is still incredibly robust. The allowance for credit losses still covers non-performing loans by nearly 3 times. Basically, they are very well insulated.
Finally, Section 5, Capital Returns and Leadership, the driver and the destination.
A healthy engine means rich rewards, right? And Truist absolutely delivered on that promise. They returned a massive $1.8 billion to shareholders this quarter. That includes essentially betting on themselves to the tune of $1.2 billion in common share repurchases, alongside a declared common dividend of 52 cents per share. And they did all of this while maintaining a highly secure Common Equity Tier 1, or CET1, capital ratio of 10.9%. That means they are highly capitalized, exceedingly safe, and still incredibly rewarding to their investors.
And hey, speaking of the road ahead, this report officially marks the changing of the guard. Mike Lyons is stepping up to become the next CEO this coming September. Current CEO Bill Rogers praised Lyons as a dynamic and highly respected leader who truly recognizes the strength of the franchise. You know, leadership transitions can sometimes cause market jitters, but doing it on the heels of a 37% EPS jump? That provides an incredibly smooth on-ramp for a new chief executive.
So, with a stellar 37% EPS jump behind them, strong commercial loan growth, a clean bill of health on credit risk, and a brand new driver taking the wheel, the big question for all of us tracking corporate finance is this: how will Truist navigate the evolving, increasingly complex financial landscape of late 2026? Will this momentum hold as rate environments shift, or is this the absolute peak performance of this particular engine? We'll have to keep a close eye on the macro economy to find out. Thanks so much for joining me for this explainer, and keep learning.